Hey everyone, welcome back to the channel. Today we're tackling a crucial question: can ULTY, the YieldMax ULTY Option Income Strategy ETF, hold up in a falling market? If you've been watching ULTY's incredible weekly payouts and thinking this could be a safe, high-yield haven, today's breakdown might surprise you. We'll analyze how its strategy performs during downturns, the real mechanics behind its income generation, and whether those high yields are sustainable when markets are red. So let's jump in. Hello viewers, if you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. ULTY is part of the YieldMax lineup, a family of ETFs that generate option income from popular US stocks or indexes. Unlike traditional covered call ETFs like YieldMax or YieldTY, ULTY takes a synthetic approach. Here's what that means. Instead of owning shares directly, ULTY uses a synthetic exposure, combining derivatives like swaps and options to mimic the returns of the S&P 500 or other assets, while selling calls on that exposure to generate income. This structure allows YieldMax ETFs to focus heavily on income generation, sometimes targeting double-digit annualized yields. But remember, there's no free lunch. Let's see how this plays out in rough markets. ULTY earns income through covered call writing on synthetic equity exposure. Every week, options are sold, collecting premium income, which funds those frequent distributions investors love. This works beautifully when markets are flat or slightly bullish. The call premiums act like rent income, helping the fund deliver consistent cash flow. But in a falling market, the math changes dramatically. Here's the problem. When the underlying market falls, the ETF still collects call premiums, but those premiums often aren't enough to offset the drop in asset value. Think of it this way: if ULTY is synthetically tracking the S&P 500, and the S&P falls 10%, the call income may only cover 1 to 2% of that loss. So while income continues, your capital may erode. That's the covered call trade-off: income in exchange for limited upside and potential downside exposure. Let's simulate a scenario. Imagine a 2025 correction, the S&P 500 drops 15%. Here's what typically happens: option premiums increase slightly, good news. But ULTY's synthetic exposure still loses value. The result: net asset value declines faster than income can compensate. Over time, repeated drawdowns could eat into the ETF's price base, reducing both yield and principal. This is why understanding total return, not just yield, is so important with funds like ULTY. Let's compare ULTY to other income ETFs. JP Morgan Equity Premium Income, lower yield, but more defensive through stock holdings and active management. YieldMax, high yield, similar strategy but more conservative. YieldMax, index-based, slower erosion. ULTY, ultra-high yield, weekly payouts, synthetic structure, higher income potential but higher sensitivity to volatility. In falling markets, ULTY tends to underperform more diversified or lower yield peers because it doesn't hold tangible stocks, just derivatives exposure. Backtests of similar option income strategies show that while short-term yield looks impressive, long-term NAV erosion is a serious concern. From 2022's bear market as a case study, high-income ETFs held up better than pure equity funds on yield, but their prices dropped significantly. That said, for income-focused investors who prioritize cash flow over capital growth, this might still be acceptable. YieldMax ETFs like ULTY, NVDY, and TSLY all follow a similar model, generate high income from popular growth assets without direct ownership. This design gives access to high-yield strategies even for expensive stocks like Tesla or Nvidia. But again, the higher the yield, the more aggressive the exposure. YieldMax is betting that investors value weekly income consistency even if NAV fluctuates. ULTY pays weekly distributions, often categorized as return of capital, ROC. That means a portion of payouts may not be fully taxable as income. Instead, it reduces your cost basis. This can be tax efficient short term, but over years it compounds NAV decline. Always check your 1099 for classification, and if you're holding in a taxable account, consult a professional. The million-dollar question: can ULTY keep paying high yields forever? The answer: not without market cooperation. If volatility drops and markets slide, call premiums shrink, reducing income. NAV erosion can also cut future payouts since distributions are based on a percentage of assets. YieldMax may adjust strike levels or structures, but there's no guarantee of maintaining those eye-popping yields. If you're seeking more defensive income, consider blending ULTY with JEPI or JEP for lower risk SCHD or VIME for dividend stability, short-term treasuries or money market funds for downside protection. That way, your portfolio balances income with capital preservation, not all eggs in one synthetic basket. So, can ULTY hold up in a falling market? Partially, but not perfectly. It'll keep generating income from calls, but its NAV will likely suffer alongside the broader market. For pure income seekers who can stomach volatility and don't rely on long-term growth, ULTY might still fit. But for balanced investors, caution is key. In a downturn, income feels comforting, but remember, the real strength lies in total return and capital durability. If you found this breakdown helpful, don't forget to like, subscribe, and share your thoughts below. How are you positioning your portfolio for a potential 2025 pullback? See you in the next video.